Apple is expected to unveil its new TV service on Monday at its event called It's Showtime in Cupertino. The stock is trading at a 4-month high, inching back up towards that $1 trillion valuation mark, partly boosted by a number of broker upgrades. Alex DeGroote is the founder of DeGroote Consulting and joins me now via the phone. Alex, thanks so much for speaking to us. There's so much speculation around this event, some saying this is Apple entering the streaming game, a report from Recode saying that's actually one of the big misunderstandings around this event, and that's not what Apple's trying to do at all. So what's your best guess of what the unveil will look like on Monday?
Sure. So I think what investors need to know is that there is a fair amount of expectation around this event, and that it will be a broad-based event, strategy plus content, which will be unveiled, which I think will lead to analysts probably making changes to their forecasts to incorporate new product spend and possibly also a new valuation approach to services revenue, which is really hitherto where things like App Store have been disclosed. So really, I think the market, Recode are sort of 50-50 right, I think, but the market should be expecting new news on streaming strategy, really, which is where Apple will look to take some market share from the well-known players, you know, the Netflixes, Amazon Primes, and Disneys of this world.
So in order to grab that market share, how important is original content going to be? Because there's reports that Apple has spent over $1 billion in 2018 and hired a number of heavy hitters in the industry. But that's only really a fraction of the annual spend when you compare it to Netflix.
It is absolutely right, Victoria. You know, we were living through what I would term an arms race in terms of production content and original content. And the guys that have really driven that arms race have been Netflix, and then following hot on their heels, mainly Amazon Prime, but increasingly the other big US players, so Comcast and Disney, and of course Comcast now and Sky. And you're absolutely right. I mean, $1 billion really is small change in the context of this arms race, because Netflix's annual spend is closer to $10 billion. Apple does have an advantage over Netflix in the sense that it doesn't have to build an ecosystem from scratch. It already has the long tail through iTunes, Apple News, and of course the App Store. So the sort of e-commerce back end is already there, but what they don't have is the content. And as you say, that's where they've been making the signings of late. And I think we're going to hear a lot more about that next week.
Well, Goldman Sachs has pointed out that this video service could ultimately only have a real small revenue potential compared to, say, the iPhone. So how significant do you think this event is for Apple's financials and the stock price?
I think it is significant. I wouldn't dismiss it at all, but I would definitely caveat it with the comment that expectations may have run ahead of themselves a little. And you mentioned the stock price of $190 plus. I think you'll struggle to see many broker target prices much ahead of, let's say, 220. So the stock price has moved aggressively already to discount lots of good news and, in a way, forget the bad news. And the bad news, of course, relates to what's going on in China and generally a pretty lackluster performance from Apple's hardware products. So we have to be balanced. But the other thing for investors to be aware of is that this is a company that has, let's say, $100 billion of net cash. And so it really has a very, very strong balance sheet. And so the market is really discounting two things. One, a fairly aggressive share buyback, and two, some fairly hefty acquisition activity. So Netflix has been linked quite closely with Apple. I suspect probably they'd turn their firepower on something a little bit smaller, but they are in the market for deals and they are in the market for buybacks. Both of those corporate actions would be accretive to earnings and would help the valuation. So I think the company overall is in a relatively good place, and certainly amongst the FANGs would be one of my two top picks.
So in the fiscal first quarter, we saw that about 62% of Apple's revenue came from the iPhone. You touched upon those difficulties within the hardware section of its business. Now, do you think that Apple really needs to try and evolve from being a product company into an ecosystem company, and that's how the company will continue its growth strategy?
Yes, I think that's a great point. I mean, if you think about their peer group in the FANG ecosystem, then they are generally device neutral and they are walled gardens. In other words, they get the consumer across multiple platforms online. They're pretty platform neutral in terms of mobile or desktop. Apple has a legacy of being a hardware company, of course, but I think in the future they want to migrate more into the software and content space and get subscribers paying on a monthly or annual basis subscription fees for content. That's a proven strategy which works for them in the content space, and crucially, it works for the other guys. The difference maybe with the other guys is that Apple to date has really been quite keen to preserve privacy at the heart of its operating systems. So that might suggest that they're less interested in going after advertising, which at the end of the day is the biggest revenue driver for most of the FANG companies.
So what about some of the other unveils that we might get on Monday? Because it's understood that there could be some kind of news subscription service, and there are also reports that Apple could be working with Goldman Sachs on a credit card. What are your thoughts there?
Yes. Yeah, so on the news, yeah, that's very well flagged actually already. Now, Apple, for the subscribers, for the investors' benefit, Apple tends to work on a sort of 70-30 split in terms of the revenue share. So if they do partner with news publishers, it will be tilted in their favor commercially. And the idea is that effectively, a bit like iTunes, you would purchase news product on a per article or per section basis. And that the economics would favor Apple, which can offer the publisher this very big audience base to access. In terms of the partnership with Goldman's, absolutely. I would be surprised if they weren't pursuing this sort of initiative. In fact, I would be surprised if all of the FANGs were not pursuing a more aggressive agenda with the big financial services players, because at the end of the day, it's all about accessing consumer wallets. And of course, one of the biggest metrics that we would look at for consumer activity would be financial services, whether that's light touch, insurance, or sort of more transaction-focused activity. So I don't think we're just going to get one announcement. I think we're going to get multiple announcements. Content will be the headline, but behind that you'll have news and, as you say, probably commercial partnerships with 2 or 3 household names. All of that should get the market excited. Caveat might be that some of this has been leaked in advance.
So taking a step back now, what's your outlook for the FANGs more broadly? Obviously, it was a very, very challenging Q4 in 2018, but those shares have done pretty well at the start of 2019. And where do you see the real opportunities in big tech right now?
Sure. Again, a great question. I would say that if you break down the FANGs quickly one by one, I would say Facebook has delivered financials which are way ahead of expectations. They're tracking very, very well in terms of their user base. The risk there might be a regulatory risk. We can hear that some of the would-be Democrat candidates for the next presidency in the US are flagging openly that they would like to break up or heavily regulate Facebook. Investors need to be aware of that. It could be an opportunity, but it could be a big risk. To some extent, those comments would apply to Google or Alphabet, so I would park that alongside Facebook. Good operating growth, but there is regulatory risk. My 2 preferred names within this space would be the 2 A's, Apple and Amazon. They operate in adjacent markets, but they have a slightly different approach, and they would be my 2 in terms of 3 to 5 year growth potential. I see those as being slightly more secure in their growth profile than the other guys. The smallest of the FANG names, of course, is Netflix. Again, continues to deliver numbers ahead of expectations, particularly outside of the US. Frankly, however, I do question whether Netflix might just be not big enough to succeed long term. Now, that might sound ridiculous for a company with a market cap of $160 billion. But I do feel that in the scheme of things, scaling up relative to FANG, they do look relatively small. By the way, could I also just add that a name that we never really talk about, but we should talk about, is Microsoft, which will be deposed by Apple on the back of this share price rise as the biggest company. But we should probably now begin to include that in this grouping as well. I think that's an interesting story as well. So you're absolutely right, Victoria. We've seen a big bounce back year to date, 2019, in these names. They've all rallied hard. From where we are now, for choice, I think my preferred names would be Amazon and then Apple. Facebook, I feel, may get battered from time to time with this political or regulatory stick.
Well, it's very interesting that you mentioned Microsoft, because I was speaking to one tech analyst recently who was saying we really need to differentiate now between the B2C and the B2B businesses within the big tech space. And he said that the B2B space is where it's really at, with the growth of cloud and other things that aren't so tangible to me. I was going to say you and me, but it is tangible to you.
Yeah.
And those are kind of the opportunities now.
Yeah, I totally agree. I mean, the other thing that we need to think about is gaming. And gaming, I mean consumer gaming, is obviously a place where Microsoft play very successfully through Xbox. Google
and now Alphabet as well?
Correct, Stadia. So gaming or development in general is a part of the equity story or investment case that we haven't really talked about in enough detail. But I think that could be a point of differentiation going forward. And of course, that is supported by cloud technology. So you're absolutely right. Cloud is often ignored. We often focus on retail, consumer retail users. But let's not forget, within Amazon, AWS has been an enormous profit driver, Amazon Web Services. And it's that cloud presence which has effectively been the cash cow, which has funded a lot of the diversification activity in other areas. So, yeah, we ignore the B2B side at our peril, and it's a very real business opportunity for all of these big companies.
Alex, thank you so much for your time.
Thank you, Victoria.
That was Alex DeGroote, founder at DeGroote Consulting. Thanks so much for watching IGTV. I'm Victoria Scholar, and we'll see you soon.